Okay, now let's go through it as if we were just flowing through on a new plan. So I'm going to click Create New Client Plan, Refinance, Add Details. Client says that they don't want to spend anything at closing. If they close, they'd like to have no out-of-pocket. So I'm going to call this Lesson 3, No Closing Cost Sample. It's one of my clients, so I have no referral partner. I'm going to call this Lesson 3 Sample Client. They have $85,000 in income. They're in a 28% tax bracket. And it's lesson3@gmail.com is their address. I already have all their client information elsewhere. They have a first mortgage. I'll put those details in. Property value is $190,000. It's a primary residence. They have a 30-year fixed right now with Bank of the West. The original loan amount was $150,000. They started that on 3/1/2008. Interest rate of 5.5. The current balance right now is $150,000. No, we'll say it's just making this up. $130,000. I'll be getting this information. I got a current payment, and they tell me that they're actually paying $900 a month. It's a refinance, and there's no MI, so I'm going to leave that all blank. They also, however, have a second mortgage. So I'm going to do second mortgage, and I'll put in the details for that. It's an equity line of credit with Bank of the South. They have $20,000 balance, and they started that same time, 3/1/2008. Interest rate on that is 4. They currently owe $20,000 because they're paying interest only, and they're paying, they said they're trying to make payments of about $70 a month. So I can put my caps and stuff in here. If this is prime, I can go in and put these in and start to show how it's going to adjust and simulate it over time to do a worst case scenario. But I'm just going to keep this simple for now and leave it like it is. So I'm just going to do a first and second mortgage. Their goal, they would like to consolidate the first and second mortgage to lock down the variable HELOC, and also look to see how quickly they could pay off their current mortgage, making the same payment they have today, and would also spend more if they could see how it would reduce their term. They would like to pay off in 20 years or less. So that's it, and we're less than a minute and a half on this page. I click the bar tab, takes me over, does my sync, and I say, all right, I'm going to go ahead and skip the 7-year arm, which is going to be a default unless you do more on the interview, but I'll tell you more about that later. So 30-year fixed. The software is already trying to get as much as they can. Now we can go to 80%. Let's just say, don't want to worry about a second right now. We want to see if we can get as much of that as we can paid off. And I'm going to keep it really, really simple. I am going to do a 30-year fix that I'm going to duplicate. So I'm just didn't have to change a thing here. 30-year fixed, 80%. It's got the interest rate in that's pretty close to what I want. See how fast it is? I'm going to come over here and say 30-year fixed with an extra payment. So I'm going to give it a different title, but you'll notice everything up here is exactly the same. I'm not changing anything here. And I'm going to go through and say in both of these is $2,500 in closing costs. So they're going to need to come out of pocket with about $2,500. They owe $152 right now on these two mortgages. I'm going to do a $152 and a $152, and they're going to have to come to closing with $2,500 because they don't have a way to get more to them unless I bump their interest rate. So if I wanted to go through and do that, I could bump the interest rate here, and let's just say we do that. 4.25 and 4.25. That gives me a higher interest rate, and I am going to give them a lender credit of $2,500. So now their closing cost prepaid net to them is 0. So everything's netting out there. Now my payment difference here, $970 versus $748 versus $748. Why? Because I'm not showing any difference here. So the closing cost is the same, payment is the same. And that's okay, because what I'm going to really do down below is play with the wealth impact, because they said they would be interested in making an extra payment. So what I want to do is they're spending $970 now. I want to spend $970 in each of these scenarios, and they're interested in repaying. So I'm going to click repaying. And they said they'd like to be debt-free in 240 months, or in 20 years. So I'm going to go out to 20 years. So the first thing I can see here is they have 264 months to go. So 20 years is 240 months. So they're on track already. I'm going to take them to 230 months if they just do my 30-year fixed with 4.25. Now, what I want to do is go in and show how they could pay an additional amount. And with the little pop-up box here, I can do anything I want to. So let's say I want to show them how they could pay off in 15 years, in 180 months. And to do that, it says you need to make an extra payment of $173. So I'm going to come in here and put in $173 per month until the loan is paid off, and click Save. So now what am I doing? First, I'm showing them at $970 a month. Either way, I can take them from $264 to $230, and that's going to save them $33,153. If they pay an extra $173 a month, I'm going to have them paid off in 181 months, and that's going to save them $56,944. Now, folks, we're under the 5-minute mark since I started the plan itself. And what I've done here is I've gone through, and if you were this client, again, forget about me, just ask yourself if you were this client, and I could consolidate you into an after-tax cost of borrowing of 3%, with no out-of-pocket, freeing you up $220 a month in cash flow. And then you could take that money, that $222 a month, and apply that towards your mortgage, which means what? You're still spending $970. You're spending $970 here. Here you're spending $748 on the mortgage plus an extra $222. That savings is being applied towards the mortgage. And you're going to be debt-free in under 20 years and save $34,000. But for an extra $173 a month, I can get you there in 181 months. So the client says, hey, this looks really neat. All I'm going to do now is go to the Present tab, and I'm going to build my case, and I'm going to go through and check all, because I like to do a full report. I recommend you do the full report, and then just show them the parts that are really relevant for them. And then I click as a print PDF. I click my as a print PDF tab. It's going to go through and build my report. So now I've got my nice presentation I can review with my client, going through their objectives, their goals, their current liabilities. I've got my first and second mortgage here detailed out. I've got my key questions. Does this make sense now where there's no cost at closing? I'm freeing up $222 either way. I'm actually going to show you how with just a little extra payment here, 30-year fixed with extra payment, we've got 181 in terms of our months here that we're going to be able to shave off. I see my proposed liabilities, my loan program matrix, my first and my second, my summary, and any other information such as in this case the nice AM tables that show year by year the financial impact of this decision. So in 8 minutes I've completely done this entire narration, the opening, the closing, explaining all that I've done. For most of you, you'll be able to create a plan in 5 minutes or less that will answer those key questions and provide a compelling argument for why your client should or should not move forward with their transaction. Wish you the best. In our next video, we'll continue the process.